The Plaza Hotel sold for $325 million in 1988. The buyer took on $400 million in debt to acquire an asset worth less than the financing required to own it. That arithmetic was not a mistake. It was the business model. Donald Trump's acquisition of the Plaza in October 1988 was the most visible real estate transaction of a decade defined by visible real estate transactions. The building had stood at the corner of Fifth Avenue and Central Park South since 1907, 81 years of continuous operation as one of Manhattan's most recognizable addresses. The Hilton Corporation had sold it. The price was $325 million. The debt Trump assumed and originated to close the transaction exceeded that figure by $75 million before the first mortgage payment was due. The Plaza was underwater before Trump signed the deed. To understand what happened to the Plaza, and what happened to it 3 separate times, under 3 separate ownership structures, you have to understand what the building actually is as a financial instrument. The Plaza is not a hotel that also happens to be a landmark. It is a landmark that has never been able to generate enough operating income to service the debt that its landmark status makes it possible to borrow. Every owner who has ever held the Plaza has paid a premium for the name, financed that premium with debt the operations cannot support, and eventually transferred the asset to a creditor or a distressed buyer at a loss that the next owner then used as a justification for borrowing against the same name at a new premium. The cycle has repeated with the consistency that forensic analysis finds more instructive than any individual transaction within it. The Plaza's debt-to-equity ratio at each acquisition has exceeded what any stabilized hospitality asset in Manhattan could reasonably service. The appraisals have consistently valued the building on the basis of its replacement cost and its cultural cachet rather than its net operating income. And the lenders have consistently accepted those appraisals because the alternative, declining to finance an iconic Fifth Avenue address, carried its own institutional risk. But the building's operating history tells a different story than the appraisal methodology. The Plaza has never, under any ownership structure, generated the revenue per available room necessary to service a capital structure size to its cultural value rather than its commercial output. The marble does not produce income. The name does not service debt. The balance sheet has always known this. The ownership has not always been willing to read it. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure. The Covenant. Nobody read. Trump's Plaza bankruptcy filed in November 1992 was, by the standards of the asset's subsequent history, the simplest of the 3. The capital structure that had financed the 1988 acquisition consisted of a first mortgage, mezzanine debt, and a personal guarantee from Trump that became legally relevant the moment the hotel's operating income fell below the debt service threshold. It fell below that threshold within 18 months of acquisition. The operating shortfall was not a product of mismanagement in the conventional sense. The Plaza under Trump's ownership maintained its service standards and its occupancy rates at levels consistent with the competitive set. The problem was structural. A $400 million debt load on a hotel that generated approximately $30 million in annual net operating income produced a debt service coverage ratio that no competent underwriter would have approved in a functioning credit environment. The transaction had been underwritten on the assumption that Trump's ownership would enhance the asset's revenue profile through brand association. The brand association produced publicity. It did not produce the additional $15 to $20 million in annual NOI that would have been required to cover the financing. By 1991, the Plaza was in active negotiation with its lenders over a restructuring that would eventually transfer 49% of the hotel's equity to a consortium of creditors in exchange for debt relief. Trump retained 51%. The personal guarantee was resolved as part of the restructuring. The asset write-down absorbed by the lenders in that transaction represented the first documented instance of a pattern that would repeat twice more. The gap between the acquisition premium and the building's commercial capacity being closed through creditor loss rather than operational improvement. The question that the 1992 restructuring raised but did not answer was whether any capital structure could be engineered to allow the plaza to service acquisition-level debt from its operating cash flows alone. The evidence from the hotel's operating history suggested the answer was no. The plaza's revenue per available room, even in peak years, has consistently tracked below the level required to service debt size to its appraised value. The covenant that no lender appears to have read carefully enough is the one written into the building's economics rather than into any specific loan document. A landmark hotel in Manhattan, operating at market rates, cannot generate institutional-grade returns on institutional-grade acquisition debt. At what point does a lender's willingness to finance an iconic address become institutional negligence? Leave your analysis in the comments below. The appraisal that didn't hold. The second chapter of the plaza's bankruptcy history arrived in 1997 under the ownership of a Saudi-Singaporean consortium led by Prince Al-Walid bin Talal and CDL Hotels International. The consortium had acquired the plaza in 1995 for $325 million out of the Trump bankruptcy estate, a price that exactly replicated the 1988 acquisition figure, despite the intervening restructuring, the creditor losses, and the documented evidence that the building's operating cash flows could not support a capital structure of that magnitude. The appraisal methodology that justified the 1995 acquisition price deserves forensic attention. The valuation was based on a combination of replacement costs, comparable sales of comparable trophy assets, and a discounted cash flow analysis that assumed a stabilization trajectory for Manhattan luxury hospitality that the market would not deliver until the early 2000s. The capitalization rate applied to the projected stabilized NOI was consistent with the compressed yield environment of mid-1990s institutional real estate. The result was an appraised value that treated the building's cultural significance as a revenue-generating asset rather than a cost-generating liability. The cultural significance of the plaza generates costs that have no commercial equivalent. The landmark designation imposed by the New York City Landmarks Preservation Commission restricts the modifications that any owner can make to the building's exterior and significant interior spaces. Those restrictions translate directly into capital expenditure obligations that a non-landmark hotel of equivalent size would not carry. The cost of maintaining Grand Army Plaza facing facades, the Oak Room, the Palm Court, and the original guest room configurations to a standard consistent with landmark status is a structural drag on operating margins that the appraisal methodology treats as irrelevant to value. By 1997, the Al-Walid Consortium was in default on its financing obligations. The hotel was generating insufficient cash flow to service the debt that had been placed on it at acquisition. The specific trigger was a combination of the Asian financial crisis reducing the consortium's liquidity position and the hotel's operating margins compressing under the weight of the capital expenditure obligations that the landmark designation required. The over-leveraged acquisition had encountered the structural liability that the appraisal had not priced. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. The architecture of denial. The third bankruptcy, the one that produced the most structurally complex collapse and the most instructive forensic record, arrived in 2008 under the ownership of El Ad Group, the Israeli development company that had acquired the plaza in 2004 for $675 million. That acquisition price represented a 108% premium over the 1995 sale price and established a new debt service threshold that the building's operating history had already demonstrated it could not meet. El Ad's thesis was not a hospitality thesis. It was a conversion thesis. The $675 million acquisition was premised on the transformation of approximately 282 of the plaza's 805 hotel rooms into luxury condominium residences, to be sold at prices that would generate enough proceeds to retire the acquisition debt and leave a residual hotel operation with a manageable capital structure. The condo conversion would effectively subsidize the hotel by transferring the burden of the acquisition premium from the operating business to individual buyers willing to pay for a Central Park South address. The conversion thesis was commercially coherent under the assumptions of the 2004 to 2007 Manhattan luxury residential market. Condo prices in the converted units reached $4,000 per square foot at peak, generating individual sale prices that validated the conversion model in isolation. The problem was the sequencing of the capital structure. ELAD had financed the acquisition with a combination of equity, first mortgage debt, and mezzanine financing that required the condo sale proceeds to be applied to debt retirement in a specific sequence. When the 2008 credit crisis compressed luxury residential transaction volume, the sequencing broke. Units that had been under contract at peak prices were returned as buyers could not close. The mezzanine debt that had been expected to be retired by condo sale proceeds remained outstanding. The interest on that mezzanine debt continued to accrue. The Chapter 11 filing that followed in 2008 was the third time in 20 years that the Plaza's capital structure had proven incompatible with its operating reality. The forensic record of the three proceedings documents the same structural failure expressed through three different ownership models. Acquisition premium financed with debt the operations cannot service, followed by a restructuring that transfers the loss to creditors while preserving the asset at a new basis for the next acquisition premium. What the marble outlasted. Sahara India Periwar acquired the Plaza out of the ELAD bankruptcy proceedings and subsequently transferred controlling interest to Subrata Roy's Sahara Group, which itself became the subject of one of India's most consequential corporate enforcement actions. By 2012, the Plaza's ownership chain had become entangled in a legal proceeding that had nothing to do with hospitality operations and everything to do with the capital markets irregularities of its Indian parent company. The building that had bankrupted three American and international ownership groups was now collateral in a dispute being adjudicated by the Supreme Court of India. That sequence is not incidental to the forensic analysis. It is the forensic analysis. The Plaza's ownership history is a precise record of what happens when an asset's cultural value systematically exceeds its commercial capacity, and that excess is repeatedly monetized through debt rather than resolved through operational restructuring. Each successive owner has paid a higher price, taken on more debt, and required a more creative financial structure to justify the acquisition. Each successive creditor has accepted an appraisal methodology that treats the building's name as a revenue-generating asset. Each successive bankruptcy has transferred the gap between the acquisition premium and the operating reality to a creditor class that accepted insufficient return for the risk it underwrote. The Plaza today operates as a mixed-use property combining hotel rooms, private residences, and commercial retail space. The conversion that ELAD initiated has been substantially completed. The retail spaces have cycled through multiple tenants. The hotel operation continues. The building has not been demolished. It has not been abandoned. It has survived 3 bankruptcies, 4 major ownership transitions, an Indian corporate enforcement action, and 80 years of being appraised at values its operations have never validated. What the Plaza case reveals about the current trophy asset market is that the appraisal methodology that has failed 3 times at this specific address remains the standard methodology applied to every comparable acquisition. Replacement cost, cultural cachet, and compressed capitalization rates continue to produce valuations that operating cash flows cannot support. The balance sheet has always told the truth about the Plaza. The successive owners have chosen to read a different document. If this case file changed how you evaluate trophy asset acquisitions, subscribe to this channel because the next case examines a building where the developer and the lender were structured as the same entity, and the conflicts of interest embedded in that structure are even more systematically instructive than what you just watched. And in the comments, given 3 documented instances of the same structural failure at the same address, what specific change to appraisal methodology or lending standards would have broken the cycle? The case file is open.